$30 billion US. Before the trillion-dollar valuations of the modern tech era, and before the cult of personality surrounding figures like Elon Musk, there was a man who embodied the explosive promise of an entire emerging hemisphere. He famously declared he would become the richest man in the world, vowing to surpass the established tycoons of the North. He was the face of the brick era, a brief moment in history when the global economy believed the future belonged to Brazil, Russia, India, and China. But his empire wasn't built on software, electric vehicles, or logistics. It was built on a narrative. A story so seductive that even the smartest institutional capital in the world forgot to check if the foundation was real. In the accounting language of global markets, this figure represents more than accumulated wealth. It represents a quantified volume of institutional trust, underwritten by counterparty risk. By 2012, this valuation was concentrated in a single corporate constellation identified by one recurring symbol, the letter X. At its peak, the EBX Group aggregated a market capitalization comparable to mid-sized sovereign economies. This valuation was not anchored in proven cash flow generation. It was anchored in forward-looking reserves estimates, subject to disclosure asymmetry. What the market priced as scalable resource extraction capacity was, in practice, a liquidity mirage sustained by optimistic recovery factors and incomplete technical disclosure. Behind the financial dashboards of global investment banks, a structural solvency gap was forming. The discrepancy between reported asset potential and verifiable production capacity was not noise. It was systemic. It was structural. It was a veracity gap. Brazil, 2010. A jurisdiction experiencing accelerated capital inflow and reputational rebranding. It was the era of the Brazil takeoff, where the country was positioned globally as a high-yield frontier for institutional portfolios. The EBX narrative functioned as a vector of institutional camouflage. Western-trained governance aesthetics were layered over an operational environment characterized by regulatory latency and enforcement asymmetry. To foreign funds, this configuration offered an appealing abstraction: exposure to commodity upside with the visual grammar of compliance. The yachts, the aircraft fleets, the geometric branding of subsidiaries, they did not generate cash flow. They generated the perception of governance maturity, reducing friction in capital raising rounds and compressing perceived counterparty risk premiums. This was not deception in theatrical form. It was capital obfuscation through prestige signaling. Welcome to Brazil Noir, the dark stories behind Latin America's most spectacular financial illusions. To reconstruct the collapse vector, it is necessary to map the financial flow architecture of the EBX ecosystem. The EBX Group was not a vertically integrated industrial conglomerate. It was a constellation of publicly listed specialized vehicles. Each entity was framed as operationally distinct. Each carried its own balance sheet. Each marketed a discrete exposure thesis. OGX, oil. MMX, mining. LLX, logistics. MPX, energy. On balance sheets, this structure appeared synergistic. In cash flow reality, it functioned as a system of communicating vessels. Liquidity was not isolated. It migrated. Capital raised in one vehicle was periodically redirected to stabilize liquidity in another. This produced temporary solvency illusions, not through fraud, but through architecture. The mechanism was structurally consistent. When one node experienced stress, another absorbed it. The system appeared resilient. In reality, risk was not dissipated. It was redistributed. This redistribution delayed market recognition of asset underperformance at the cost of compounding systemic exposure. The architecture did not fail immediately. It failed by postponement. It's a bloodbath. Sell everything. We're exposed in the Asian markets. Clear the books. I want everything liquidated by noon. The core risk vector concentrated in a single entity, OGX. All stabilizing flows ultimately pointed in its direction. When OGX weakened, the entire constellation absorbed stress. This dependency was not fully visible to the market because it was not a legal dependency. It was a liquidity dependency. And liquidity dependencies do not appear in corporate diagrams. They appear only under stress. At this stage, the EBX ecosystem was no longer a collection of companies. It was a single liquidity organism, and OGX was its heart. In 2011, OGX reported estimated reserves in the order of 10.8 billion barrels of oil. For capital markets, this figure was not a number. It was a signal of scale, of longevity, of inevitability. Embedded in this estimate were technical assumptions regarding recovery factors, reservoir continuity, and extraction efficiency. These assumptions implied recovery rates that exceeded regional geological baselines. In isolation, this might appear as technical optimism. In aggregate, it represented a systematic elevation of low probability outcomes into base case narratives. This produced a veracity gap between geological possibility and economic recoverability, between what could exist and what could be extracted at scale, at cost, and within time. Markets, however, did not price uncertainty. They priced a high probability production curve. They priced smooth ramp-ups, stable plateaus, predictable decline profiles. Internal technical indicators, however, pointed toward non-linear behavior, elevated water cut, pressure inconsistencies, operational volatility. These indicators did not disappear. They were disclosed, but they were disclosed as secondary signals, buried in technical appendices, framed as manageable variance. This was not a data vacuum. It was a selective transparency regime. High uncertainty indicators were elevated to headline narratives. Low confidence signals were phase shifted into high confidence market expectations. In forensic finance, this process is known as informational phase shifting. It does not fabricate data, it reweights it. The market did not misinterpret the information. It was conditioned to misweight uncertainty. As long as production confirmation remained in the future, the narrative remained liquid. And liquidity, at this stage, was the primary objective. But beyond balance sheets and liquidity loops, there was another dimension to the narrative around EBX. At the height of the collapse, with market confidence evaporating, the controlling shareholder did not retreat into spreadsheets. He sought an unusual remedy. A so-called esoteric consultant was brought into the group's headquarters. Her diagnosis? The symbol that adorned every company logo, the sun, was facing the wrong direction. According to this council, the rays should turn in the opposite orientation to restore harmony and good fortune. In response, the visual emblem of EBX was subtly altered, not in legal structure, but in symbolic alignment. This episode, strange though it may seem, reveals something deeper. A blend of hubris, irrational optimism, and the search for causality beyond data when certainty has fled. The ostentation was not limited to corporate branding. At the empire's peak, a Lamborghini Aventador, a supercar worth millions, sat on display in the living quarters of the entrepreneur's residence. When fortunes reversed, the same Lamborghini was put up for sale as part of personal financial restructuring. These were not mere toys. They were symbols of a worldview where narrative worked in tandem with aspiration and belief substituted for economic ballast. For a long time, the market behaved as if EBX carried an invisible safety net. Not a formal guarantee, not a contractual protection, but an implicit belief. That belief was simple. If things went wrong, someone would step in. A strategic buyer, a global major, a sovereign fund, or the controlling shareholder himself. This belief functioned as a synthetic put option, not priced, not hedged, but assumed. As long as capital inflows continued, this assumption remained unchallenged. Debt was rolled. Equity dilution was postponed. CapEx schedules were reaffirmed. The system appeared stable. But stability was conditional. It depended on one fragile premise, that there would always be a buyer of last resort. This premise was never tested in a stressed environment until it was. When production targets were missed and operational inconsistencies could no longer be reframed, confidence fractured. At that moment, potential rescuers did not step forward. They stepped back. Strategic buyers ran their own models. They applied their own recovery assumptions. They discounted execution risk, political risk, and reputational risk. The resulting valuations were incompatible with the capital structure. There was no price at which a rescue preserved equity. The synthetic put expired worthless. When the market realized that the floor did not exist, pricing dynamics changed abruptly. This was not a gradual repricing. It was a discontinuity. Liquidity evaporated. Bid-ask spreads widened. Secondary offerings failed. Debt markets closed. What had functioned as a growth story became, almost overnight, a solvency question. At this stage, narrative alone was no longer sufficient. Cash flow had to speak, and it did. Once confidence fractured, liquidity did not simply decline, it turned reflexive. Price weakness began to generate its own justification. Falling equity prices were no longer interpreted as volatility, they were read as information. Signals of hidden risk, of undisclosed fragility. This is the core of the liquidity feedback loop. Price declines, reduce confidence. Reduced confidence limits access to capital. Restricted capital access forces asset sales, project delays, and operational compression. These actions validate the original fear. The loop closes. In the EBX ecosystem, this loop was amplified by structural leverage. Projects were capital-intensive. Cash flows were backloaded. Debt service, however, was front-loaded. This asymmetry left little margin for execution error. As equity collapsed, credit metrics deteriorated. Covenants tightened. Waivers became conditional. Each negotiation signaled distress. And distress, once visible, travels faster than reassurance. Ratings agencies reacted, not as initiators, but as accelerants. Downgrades triggered forced selling. Institutional mandates were breached. Liquidity providers stepped away. The feedback loop tightened. At this stage, management communication lost efficacy. Conference calls were no longer informational. They became defensive rituals. Guidance revisions were interpreted as admissions. Silence as concealment. There was no safe message left. What mattered now was survival. And survival required liquidity that no longer trusted the system. At the height of the EBX expansion, the system did not lack warning signals. It lacked incentives to interpret them correctly. This is where institutional camouflage becomes visible. The group was surrounded by first-tier institutions, global investment banks, prestigious law firms, renowned auditors, technical consultants with international credentials. To the external observer, this constellation functioned as validation. If everyone reputable was involved, the structure must be sound. This inference was incorrect. Institutions did not certify truth. They certified process. Legal opinions confirmed formal compliance, not economic viability. Audit reports validated accounting treatment, not future cash flow realization. Bank research modeled scenarios but relied on management inputs for geological assumptions. No single node owned epistemic responsibility. Each actor outsourced truth to the next. This produced a closed loop of validation, not verification. In this architecture, dissent was expensive. Analysts who challenged assumptions risked losing access. Bankers who questioned feasibility risked losing mandates. Consultants who downgraded probability risked contract termination. Silence was rational. Optimism was rewarded. This is not conspiracy. It is incentive alignment under uncertainty. The system did not lie. It selected which truths were economically viable to express. Institutional camouflage is not built to deceive regulators. It is built to reassure capital. And capital, once reassured, rarely demands epistemic rigor. By the time institutional tone shifted, the structure was already brittle. Camouflage does not prevent collapse. It ensures that collapse, when it comes, is total. Every financial collapse has a precise moment. Not when losses peak, not when bankruptcy is filed, but when the market stops listening. For EBX, that moment was operational. Production data from OGX began to converge toward a single conclusion. The wells were underperforming, not marginally, structurally. Decline curves were steeper than projected. Flow rates failed to stabilize. Recovery factors collapsed toward regional baselines. What had been framed as exceptional geology was reverting to statistical normality. This data was not ambiguous. It was not interpretive. It was terminal. From this point, no financial engineering could restore value. No refinancing, no asset shuffle, no symbolic reassurance. The asset could no longer support the narrative. Equity prices did not decline smoothly. They fell through liquidity gaps and net trading halts. Volatility auctions forced liquidation. This was not panic, it was recalibration. A rapid convergence between price and reality. The market was no longer pricing upside, it was pricing salvage value. At this stage, communications ceased to matter. Statements were ignored, clarifications were discounted, promises were treated as noise. The market had completed its cognitive shift from belief to probability, from expectation to damage control, from growth to containment. Once this transition occurs, collapse is no longer a risk. It is a process. Formal collapse does not begin with bankruptcy filings. It begins when losses are redistributed. As EBX entities enter judicial recovery, the capital had already moved. Institutional investors had reduced exposure. Hedges had been activated. Losses had been provisioned. What remained was concentrated retail investors, Brazilian households who entered the market during the expansion phase. For many, this was their first equity exposure. They did not buy volatility, they bought narrative, national assent, resource sovereignty, participation in a rising Brazil. These positions were not speculative, they were temporal. Retirement buffers, education funds, deferred security. When prices collapsed, there was no exit strategy, no diversification, no hedging, no recovery horizon. This was not drawdown, it was erasure. What disappeared was not capital, it was stored labor. Years converted into digits, digits converted into zero. This layer of loss does not appear in market summaries. It appears in postponed retirements, abandoned plans, compressed futures. Losses were socialized. Accountability was deferred. Accountability did arrive, but it arrived after irreversibility. Investigations were opened. Reports were commissioned. Hearings were scheduled. But by the time the system began to ask questions, the capital was already gone. Assets had been impaired. Structures had been dissolved. Liabilities had been renegotiated. The system was not designed to reverse damage, only to document it. Regulatory response was procedural, not preventative. Rules were revised, disclosure standards were expanded, oversight frameworks were reinforced. But all reforms were downstream. They addressed yesterday's failure, not tomorrow's incentive. This creates a dangerous illusion that systems learn empirically, that they adapt. Risk does not disappear, it migrates. From one structure to another, from one narrative to the next, from one jurisdiction to a more permissive one. The EBX collapse did not end a pattern, it completed a cycle. The market did not miscalculate risk, it misclassified narrative as asset. Surface transparency was mistaken for structural integrity. Visual modernity preceded institutional solidity. This pattern is not Brazilian, it is systemic. In every cycle, a new interface emerges, a new proxy, a new promise of frictionless growth. Capital will follow. Institutions will validate process. Oversight will lag. And households, once again, will absorb the tail risk. Your attention is not entertainment. It is a distributed audit. The system does not internalize. Maintain analytical vigilance. The next anomaly is already under construction. If you want to understand the architecture of the next financial illusion before it collapses, subscribe to Brazil Noir. We don't just tell the story of the crime, we map the system that made it possible. Join the investigation.